Can you give me a signal in the industrial real estate market that you think most investors might be missing right now?
I think a lot of investors are painting SoCal with a broad brush, and they're not leaning in to some of these more insulated, irreplaceable infill pockets like their competitors are.
Well, it's my great pleasure to welcome everybody today to Buchanan's County Capital Podcast. I'm Robert Brunswick, Chairman of Buchanan Street Partners, and very excited to have today our special guest, Makenna Peter, who is a director in Orange County's JLL Capital Markets office. I think today we're going to take a deep dive into the world of industrial real estate in Southern California, where Makenna has been involved in over $1 billion of transactions. Amazing since joining JLL back in November of 2020. So quite a productive first 5+ years. And I think as evidenced by her performance, Makenna has been recognized not only as a Rising Star Award winner at JLL, but also within her industry leadership at CREW, which is the Commercial Real Estate Women Network, where she serves both as an exclusive board member, or I should say an executive board member, and co-chair of CREW's Emerging Leaders. So very excited to have you, Makenna. I remember several months back seeing you in action moderating a panel at JLL's Orange County's conference with a big crowd, and your poise and leadership was really amazing. And it made me, I took note and I said, I got to get her on the podcast. She'd be great. Maybe if you could help us get to know you a little bit, maybe by describing your background, where you grew up, your life as a kid, and education, and then how you chose this career.
Yeah, absolutely, Robert. And thank you. That is a very generous introduction. And I'll start by saying that I appreciate what you built here with County Capital, providing listeners with access to real practical insights. I am an avid podcast listener myself and have gotten a lot of my knowledge and insights from them. So it's really a privilege to be on here today. Your question was about my background. I had the privilege of spending my early years growing up in San Diego, in Point Loma specifically. And my father was a successful fire chief. My mother worked in student affairs, and thus, I guess, a commercial real estate broker was born. Growing up, I really was what my parents called a serial entrepreneur. The goal was always to find a new way to make a buck. And being the oldest of three, my younger siblings were often along for the ride on many of those endeavors, some better than others. But it really wasn't until high school when I participated in the Aaron Price Fellows Program. And it's a fellowship where I first met Robert Price. And that was also where I heard the term commercial real estate for the first time. And my only context was that it was something that Robert Price did. And that alone was enough to make me curious. And so I called his office, I bought a blazer, and I showed up asking if he'd tell me what this commercial real estate thing actually was. And his response was simple. It quite surprised me, but he said, if you really want to learn, you can start the Monday after school breaks for summer. And so I did. The summer after my junior year of high school, I held my first real estate internship at Price Philanthropies. Around that same time, USC's Sol Price School of Public Policy had just launched their undergraduate real estate development program. And on my last day as an intern, Robert made me promise I'd apply. So I kept that promise, and the rest is history, I guess.
So you went to USC that was undergrad?
Correct. Yeah.
And just a little background for everybody on Robert Price. Talk a little bit about the Price family and where they had made their success.
Yeah, absolutely. So Sol Price, many of you today probably know Costco. At one point, it was Price Club, and that was really where the family got their start. Robert Price is the son of Sol Price, and since then they have embarked on a handful of endeavors. They run a fellowship program in San Diego that is in remembrance of their son, Aaron Price. And it's really an incredible program. They take 40 students across San Diego County and expose them to different career paths. So they've done a lot in the education space. You know, a lot of people are familiar with the real estate development program at the University of Southern California, and that is all thanks to Sol Price and his family.
Helpful on the background. And I think as I think about the real estate industry that I grew up in, and, in large part similar today, it's kind of a old boys network a bit. And it's got a lot of old school conventional, protocols and processes. And I think one of the things that I enjoy seeing now is its evolution to like other asset classes. And so I think about, the evolution of it in terms of diversity and inclusion. And I think from your early career experience, what has helped you stand out and build momentum in this conventional space?
Yeah, really good question. I mean, I think it comes down to two things. I think first and foremost, it's showing up in person every day. I can't begin to tell you the number of times that really early on in my career, a senior producer pulled me into a meeting or a deal or a pitch just because just so happened to pass them in the elevator bay, or they caught me working late on something else. So I think that is essential, is being there, showing up, getting involved, attending networking events, and really trying to grow your network that way. And then I think the second piece is repetitively asking yourself the question of, how can I provide value? And I think that early on in your career, it's really easy to think that your value proposition is limited. But I don't think that's correct. There's always something that can be improved, whether it's streamlining a workflow, getting comp information from, the analyst at the other shop that maybe you went to university with, taking detailed notes in a client meeting, today, figuring out how to utilize AI within your team. And I think that if you go into every day and every conversation you have asking how you can provide value, that in turn you will receive value from that person. And, the rest gets easy from there.
I think I like it. You're speaking about the concept of reciprocity, which I'm a big believer in. Put yourself out there, give with no anticipated return on that, and build your brand that way. And clearly, you are doing that. So congratulations at a young stage in your career. So you touched upon a few, well, I'll call it industry phrases or words. So help us understand, what does a director within JLL's capital markets do?
By the book, a JLL capital markets director is a senior deal professional who sources, structures, and executes transactions for clients looking to buy, sell, or finance commercial real estate. But since you're asking me, my answer is that we're really just professional matchmakers. And the best people in our space tend to be the best listeners, and they tend to be the most creative.
Well, I like that. So we're going to dive into industrial real estate and more detailed aspects of what you do. But I think you primarily have a sales function. Is that fair? Building relationships with users of capital and owners of industrial real estate in Southern California, and help them buy, sell, source capital. Is that a simple way to phrase it?
Yep, absolutely.
Great. Well, we're gonna understand that more by some example transactions. But talk a little bit about the industrial real estate market in Southern California, the different tiers, kind of different profiles of industrial space, and how you participate in that regard.
Yeah, we could talk all day about this, but it's really exciting. What I'll say for those that maybe don't spend as much time in it as you or I do is that the Southern California industrial market is a 1.8 billion square foot market. It's arguably the most prolific in the country, and it's essentially the Super Bowl of commercial real estate, is what I like to call it. It It serves as a critical logistics gateway for the entire country. We're anchored by the ports of Los Angeles and Long Beach, which rank as number one and number two in the country. And then we have a population of 25 million people, and that population spends closer to what a population of 50 million spends. We have the ocean to the west and mountains to the east, and so we're inherently land constrained. And when you compile all of those factors, it results in the market that we're sitting in today. As it pertains to different components of the market, we love to talk about Southern California as a whole, but given the fact that it is a 1.8 billion square foot market, we have to remember that there are various silos and very different demand drivers across the region. The Inland Empire is our largest market, and it truly is the region's powerhouse. It features a lot of what we consider big box logistics and distribution facilities. So think buildings that are 500,000 square foot plus. It's where major retailers, e-commerce giants, and third-party logistics providers establish their West Coast distribution networks. And then you have both Los Angeles and Orange County. Both of these markets are a bit more diverse in terms of their demand drivers. You see both last mile distribution as well as really strong manufacturing demand, specifically recently for industries like aerospace and defense. And then there's also San Diego, smaller market, but a market where we witness a lot of business park product, specialized manufacturing, and local distribution. And a lot of that is linked closely with cross-border activity into Mexico as well.
Makenna, I appreciate you describing the industrial space, which really drives a lot of your activities. But you drive around Orange County, and you're going to see all sorts of B and C and 10 to 40,000 square foot smaller industrial products. So where does that fit into the overall ecosystem, if you will?
So what you're describing is the average age of inventory for product in Orange County is actually 1970s construction. And if you look at sort of what these buildings feature, you're not going to see the 36-foot plus clear heights that you see out in the Inland Empire. They're typically lower clear. They're typically built to a lower coverage, and they have ample auto parking. The one factor that really is important for a lot of what drives Orange County demand is power. And you have a lot of advanced manufacturing users here in Orange County that these B and C buildings are highly functional for. So it's a different type of product, and it's different demand drivers. That product functions very well in Orange County. I will say, given everything that has happened recently, I'm sure you're going to ask me about tariffs. Orange County's been able to remain pretty insulated, given the fact that these users are really, it's a different ecosystem and different demand drivers that they're working off of.
Well, I am going to ask you about tariffs, but I want to. So when I started in the business, four major food groups: office, industrial, retail, and kind of multifamily, and that was the real estate space. And now you look at the greater real estate space, and there's 20 subsections of real estate that you can participate in. Whether it's manufactured housing or self-storage or golf courses or whatever the case may be. So you think about the stability of industrial as one of the go-to product types that most institutional investors want to participate in because it's had not much volatility and it's been quite predictable. But in this current market that we've been in for the past couple of years, we've seen that volatility increase and that predictability decrease, in large part maybe because of tariffs or just a shift in the viewpoint of the user and the developer. So can you help package tariffs in that context for us?
Yeah, absolutely. I'll start by setting the stage for those that may not track port volumes as closely as us industrial junkies do. The San Pedro Port Complex processed a total of 20 million TEUs in 2025. TEU stands for 20-foot equivalent unit. It's essentially how we measure cargo capacity. Of this 20 million TEUs, roughly half of this product was tied to China. And so when you take this into consideration, the fact that 50% of what comes through our port complex is tied to China, you can begin to understand the impact that the events of April in 2025 or Liberation Day had on our market. What we began to witness from the capital markets side and from the investor standpoint were these investors really digging into the business models and the financials of a lot of these Asian 3PLs. And these are the groups that distribute the product that is coming in through our ports across the US. And there were quite a few processes at this point in time. So again, April 2025, really through the summer of last year, that were put on hold immediately following these announcements. And a lot of those deals have still not been able to transact today because what we witnessed was a flight to tenant credit and tenant quality. What I will say is that I do believe we are past the point of peak negativity following Liberation Day announcements. But a lot of those announcements have just drastically changed the way that both users are looking at the market and investors as well.
I like the articulation. And then just to understand it a little bit more, is this, you kind of said the peak to this reaction. So are you seeing things start to return to some normalcy in terms of user decision making and investor willingness to invest in maybe, I'm going to call it second tier credit, if you will?
We are. And actually, we're in the middle right now of a deal. It's a brand new construction deal that we are selling with two Asian 3PL tenants in the building. And I think, had you asked me 9 years ago or 9 months ago if a deal like that could transact in today's market, I think we would have been unsure. What we are realizing is that this Asian 3PL demand is here to stay. The issue that we had post Liberation Day was that the Inland Empire market had witnessed almost 300% year over year rent growth. And so when you have these 3PLs that operate off of margins and they have contracts with, various manufacturers, right? And those contracts are set when the cost to import the goods increases, right? That supply chain is now inefficient. And so what we're seeing largely is that if you have a deal with a fresh lease, meaning that lease is at today's market value opposed to peak values from 2 years ago, investors are willing to lean in and they feel really good about the business model. Where the concern arises is with some of these buildings that are over rented and the inability to assign any credit to that above market income, given the concern, over the tenant's credit.
Well, you explained that well. So let's stay on this kind of the math side of the equation, because a lot of our listeners are just broad-based investors, high net worth family offices, registered investment advisors. So they participate in all aspects of the investment space, whether it's private credit, venture capital, whether it's fixed income, or just the equity market. So real estate is really a proxy to alternative investing, and it's somewhat yield driven. And a lot of real estate has really been a proxy to a fixed income like investment with some benefits of inflation hedge and maybe tax benefits. So as we think about the metrics of valuing real estate, help us understand the regularly used cap rate association with valuing real estate. And what changes have you seen over the past couple of years in terms of that cap rate valuation?
So a cap rate or a capitalization rate is, as you alluded to, one of the most fundamental metrics in commercial real estate. It is calculated by dividing a property's annual net operating income, or NOI, by its purchase price or current market value. So, for example, if a warehouse generates $1 million in annual NOI and sells for $20 million, that would equate to a 5 cap rate. Lower cap rate signals you're paying more for each dollar of income, and therefore we witness tighter cap rates, typically for premium locations, premium product, and tenant credit profiles.
If you go back 2 years, a cap rate for an institutional quality industrial property would be what?
So, am I allowed to go back to 2021 and 22? Because I think that's when it really got exciting. And then I'll answer your question and then I'll talk about today. But for context, and I I hope for everyone's sake that this is the lowest cap rate we ever witness in the market out here. But in 2022, at the peak, we had really the perfect storm for industrial real estate in Southern California. I mean, we were operating in an environment, as you know, where rents were increasing dramatically year over year. Um, and investors were underwriting double digit rent growth multiple years in a row. And what that allowed for were some incredibly aggressive cap rate assumptions. And so I love to reflect on, the tightest cap rate deal our team ever sold was a 10-year leased Amazon deal at a 288 cap rate in the Inland Empire. I don't think we're going to see those days again. That was the perfect storm. If you flash forward to, let's say even 2 years ago, 2024, we began to see a softening from a fundamental standpoint. We had rate volatility that we were dealing with. And I would say that, best of the best at that point in time, groups probably thought was closer to a low to a mid five cap. Flash forward to today, I'm going to say that I'm optimistic. We're seeing liquidity in the system. We're beginning to witness groups plug rent growth back in, albeit it's something closer to, a 4%, rate over a 10-year CAGR. At the end of last year, the best deal I can share with you that sort of validates where I think today's pricing was a 13-year leased triple B plus pharma credit deal in the Inland Empire. We sold that at a 4.88 cap rate on in-place rent, and the important, asterisk there is that in-place rent we believe to be market right, because with some of these cap rate deals you're seeing, you have an in-place rent that's either above and below, and therefore not purely reflective. But I'd argue that groups in the market today would potentially push inside that slightly for an infill location in Los Angeles or Orange County if the credit and the lease term is there for best of the best.
Sure. And obviously, when we talk about cap rates, we're talking about, in essence, a return to the investor on an unlevered basis. Obviously, if you apply leverage, then if the leverage is higher than the cap rate, it's non-accretive to your return, and vice versa. So, just so that our audience understands, we're really talking about unlevered buying valuation. So, institutional capitals in the market looking today. And what in particular would you say they're targeted on, if you kind of had to frame the box that they're looking to buy into today?
I would say most of the activity from institutional capital today we're witnessing in the value add space. There has been a recent reemergence of core plus capital, that being driven by the desire to come in on a deal where you have 3 to 4 years of lease term remaining and you're not having to deal with, any softening in fundamentals that we're currently witnessing. From the core capital standpoint, you still have Odyssey redemption queues that are easing, but I would say we're beginning to see some life among a few core LPs, although it really is a short list, one of those being the group that bought the 488 cap I mentioned. And then in terms of check size, large deals have been really challenging over the last 2 years, but we're beginning to see some appetite for larger trades and portfolio trades. Although the pricing in that space is still below peak levels and investors are highly selective. So you're seeing a lot of these portfolios, be broken up and, groups wanting to bid on a portion of, but not the entire thing. In terms of product, you brought this up a little bit with Orange County and some of the smaller buildings, but we're seeing a lot of demand for multi-tenant and shallow bay, especially in high growth markets. Largely this is attributed to the fact that the future supply pipeline for this product is non-existent and it's incredibly expensive to replicate. So a lot of demand there. And then I think largely like what everyone's talking about right now is what we like to call the 3 Ps, and that's people, power, and parking. It's what these users are focused on. And I think if you can buy with that in mind today, you'll be in a really great spot.
So supply demand balance imbalance. What are you seeing? I mean, obviously vacancy rates have gone up. Um, how are you kind of projecting out supply deliveries, and which correlates to at some point, pricing and the tenant demand. So how do you see that at the moment?
Right now, from a supply standpoint, less than 1% of the existing inventory is under construction across Southern California. So that's great to hear. You also have these other factors like AB 98, which is restricting warehouse development. And we could talk about that for 30 minutes. But, you have a lot of these factors that, from a supply standpoint, it looks really positive. We are seeing demand, albeit it's selective and it's very micro market specific within Southern California. And it's also building size range specific. There's some size ranges in the Inland Empire, specifically the bulk space, that we're seeing tremendous activity. There's some others that we have some existing years of inventory to work through. So, I would say it really takes digging in and crafting an investment thesis and working with someone who spent the time to really bifurcate the market and the metrics to pick your spots.
So I'm gonna put you to work now. I enjoy hearing a pitch. So I'd like you to kind of pitch an example of an investment opportunity to a prospective, let's call it passive investor, maybe not institutional, not looking to do value or opportunity investing, want something more core predictable, as you would pitch them to make an investment in industrial real estate.
I'm biased because this is what I do all day for a living, but I think the pitch for investing in Southern California industrial real estate today is quite simple. We're home to the largest port complex in the country. We have the population, we have consumer spending and the labor, and we're land constrained. And I think that you need to focus on what's happening with legislation like AB 98 and how increasingly difficult that is making it for future development. And I think that when you take those components and you look at where product is trading today from a basis relative to replacement cost standpoint, I think the story sells itself. A lot of the opportunities that are out here in the market today are really what I'd consider generational opportunities. And I think that we're going to look back at some 2026 vintage acquisitions and say, wow, those people were really smart. They were, buying long-term lease product with credit at a basis that's lower than what I could turn around and go build it for today.
And range, I know you talked about. So is a five kind of what you would probably look to get on a broad basis on an unlevered return? Is that kind of a fair valuation metric for return on investment?
I think it's somewhere between a 4.75 and a 5 today, depending on the location within Southern California and then really the credit profile of the tenant. The other factor is the contractual rent bumps. So if you can find an opportunity with 4% bumps, that allows you to really push into the thinner side of that, right? Versus something with, 2.5, 3.
And if I want to go buy a $5 million multi-tenant, 20,000 foot building, probably not going to get it for five. But tell me how that might price. Is that a comparable return? So you really don't go down, you don't go up in terms of yield if you go to older buildings that are smaller.
Yeah, yeah. No, no, good question. There's a gapping out that occurs there. What I will say is that um, tough to peg, but there's probably a 75 bip spread, give or take, depending on really the vintage, the location, and what we're talking about there. We are still continuing to see more rent growth. And so that's why you're seeing some groups lean in, is that space has been relatively insulated from what's happening in the big box distribution market. And so those deals have been really competitive and highly sought after from investors today.
So to help the audience, just in case you said 75 bip. So I think you're saying that the 475 to five cap moves to maybe a 5.5 to a 5.75 for maybe a second tier older asset. Is that what we're
Correct.
okay?
Correct.
Good.
Yes.
just for clarification. So can you describe a few recent assignments, whatever you're comfortable and allowed to talk about, that would give us a sense for kind of the breadth of your skills and responsibilities and the profile of client and what you were hired to go do and what you did?
I will say a lot of, and this is what I love about being a broker, is you get to adjust what you're working on with the market and what works, right? And so there have been years in my career that, I focus on a lot of equity placement for development. And there's been years in my career where, I sold a lot of vacant buildings or buildings with 1 to 2 years of WALT because everyone believed in the rent growth story, and an empty building was better than a leased one that was below market. Um, and then it's, more recently sort of shifted to an environment where some of these longer WALT credit sale leaseback deals are in vogue. And so, um, I would say that that's the incredible part about being a broker, is the ability to really shift to, where investor trends are right now. We've recently been working with a lot of these closed end value funds. And a piece of that is you have these groups that, bought deals 5 years ago. The fund is coming up, and it's time to go redistribute those earnings and roll it into the next fund. And so we have aggregated quite a few, both core plus and sort of value add portfolios across Southern California, with a lot of smaller infill assets, because again, that's pricing really well and they're incredibly difficult to go replicate. And so we're finding the most success and the most liquidity for assets like that. I mentioned the large core deal that we worked on, $100 million deal there. Some of these portfolios, even if they are getting broken up, are, in the just sub 200 million space. So from a deal size, it's really the range. I also worked on a $12 million sale leaseback last year. So I think the incredible part again of really this role in this space is just the breadth of what you get to work on and who you get to work with, having it be anywhere from Blackstone to a local family office or an owner user in the market.
Well, perfectly said. I want to make sure that our audience follows you on the acronyms. So, WALT, weighted average lease term for your rent roll of your tenants. So, obviously, the longer the WALT, the more predictable the cash flows, and maybe it enhances your cap rate on behalf of your seller. Um, so, can you mention value? What do you pick up in yield to go from pure core to value in your world? How does that price?
Yeah. I would say, really like the best metric to look at is looking at it from a IRR standpoint or an internal rate of return, right? Over that hold period. I mean, typically today we are seeing, and I can, maybe quote it on unlevered returns, which is probably easier to look at, but the caveat being hopefully you're able to get some accretive financing and juice those yields a little bit. But from a core standpoint, we're really seeing deals go down in kind of the 6 to 7 unlevered range. Anything core plus, is really sort of in that 8 to 10 range, right? Probably a 12 to 14 levered. And then in the value add space today, most groups are looking for a, 12 to 14 unlevered, a 15 to 17 levered. And then going as far as, anything opportunistic and development, it's really a 21 levered IRR plus. We are seeing development, which I know is probably surprising for some people to hear. A lot of it is these deals that are coming up upon some entitlement expirations in the market. And so the path is to move forward and to build out of it. And I think groups are looking at the supply pipeline and liking the ability to get in at some really accretive yields today.
So, as I think about my baby boomer generational seat at the table, I'm very respectful and enjoy seeing the next generation kind of do what they're doing. And I'm going to guess, and you don't need to tell me exactly unless you want to, that you fall maybe between a Gen Z and a millennial. So, can you give some perspective to my generation and maybe just our listenership about your kind of views on a work-life balance? Because there's there every generation and demographic group seems to get stereotyped. So I want to give you a chance to change that stereotype.
I appreciate it. Thank you. I would like to change that stereotype. I'm probably biased because my perspective on work ethic was shaped by my father, who was a fireman that took every overtime shift offered to him ever in his career. And I think that he really showed me from a very young age what consistency and sustained effort over a career look like. But what I will say is that what I admire most about my dad is how he proved that you can work incredibly hard and still put your family first, no matter what meeting he was in. If his wife or kids called, he'd answer the phone and you'd hear him say very calmly, he'd say, "I'm in the middle of something. Are you okay? And can this wait?" And without fail, 30 to 60 minutes later, your phone would ring and he'd be ready to walk you through which soap to use when washing your car or where to find a screwdriver in the garage. And so I think as it pertains to work-life balance, and I hope he listens to this because he'll be really excited to hear it. I really do believe that intensity at work and presence for family aren't mutually exclusive. I think it's important that you find the right people to work with that share that mindset. But I think that you can do both. And I think it ties back into my comment earlier about showing up every day. I've seen a lot happen for me in my career and been the beneficiary of a lot from that standpoint alone. So I'm going to keep doing it regardless of the stereotypes. And I hope that others do too. And we can shift that stereotype eventually.
Yeah, well, you represent well, and I would say that there is a misnomer on that stereotype. But we all have our own memories of our upbringings and our experiences, and when we see things that are a little bit different, we tend to assume that they don't maybe have the same views and vision like we did. But it's a pleasure to hear you share that stuff. So provide me some maybe takeaways for young listeners as they think about building a career themselves, because obviously, as evidenced by your success, you'd be a good young mentor for them as they think about getting out into the work world, which is getting tougher today to find that career path or that job opportunity.
I think there's a lot of negative talk right now around entry level careers. And I think that a lot of it stems from fear, this fear that AI is going to replace analyst roles that previously existed. And I will say I do subscribe to the sentiment that it's not AI that's going to take your job. It's the analyst or the classmate next to you utilizing it that is. But what I will say on the positive note is that the access to information that someone starting and building their career has today is incredible. It no longer takes 30 years of experience, not to discount that experience, but to step into a meeting and provide value. And so, I really do think that is what has allowed me to succeed in my career thus far is really that access to information. And I hope that younger listeners hear that and feel empowered and candidly excited. And I'd say outside of that, find a mentor you trust, even better if it's multiple mentors, and then do everything in your power to ensure those mentors know what your goals are. If I look back to almost every pivotal moment in my career, I can directly trace it to a conversation I had with a mentor where I shared a goal, whether that was, hey, I want to work on a deal of this profile, or I want exposure to this, or I'd really like to meet this person. Um, and that, I think people want to help. And if you help people help you, I think really incredible things will happen.
So, no doubt you have mentors, you've had mentors, and I too subscribe to the mentor experience. And sometimes the person doesn't even realize they're a mentor to you. You're just listening very
I
attentively,
have a
and
lot of those.
yeah, a lot of those. And I think
Yeah.
that's quite valuable. But is there any words of wisdom that a mentor provided you with that you kind of carry forward in some of your actions and work today that ring a bell for you?
Yeah. I mean, really early on in my career, it was before you leave every day in the office, send a note, walk into someone's office and ask if there's anything else you can do. And it sounds very simple, and most of the time the answer will be no. There'll be a few times where they say yes, and you're like, oh shoot, it's 10 p.m. and now I'm here for another hour. But I think that when you show people that you're hungry and that you have the grit and you want to work hard, I think you'd be surprised how few people actually do that. So
No, I'm not surprised because I've seen it, but it's quite clear that your success and rise at a very young age is not accidental. It's through purposeful effort, and you take it seriously, and but you enjoy what you do. I mean that's very uh, much evident. So I can't thank you enough for doing this today. I'm quite confident that our audience got a lot of good education in hearing you share, and I'm quite confident that you'll carry forward your good work at JLL and your own career. I mean, some of our learning today, I think about just showing up. You talked about that. So again, your success has been purposeful and not accidental, and you continue to be a curious life learner person. And I like how you referenced about access to information because I think that is a differentiator to continue to up your game with knowledge and not just kind of rest on your laurels and be passive in that regard. Ask for the order, showing up in people's office, and how can I help? Right? Oh my gosh, that's unusual. Who was the last person to ask me that question? Right? So what a differentiator. So find mentor you trust. Big fan of that. And then the generational opportunities to invest. I think that was a great thing to think about. The wealth transfer that's going to take place over the next 5, 10, 20 years is amazing. And to maybe do that in concert with your younger family members to teach them and provide them with assets that provide some predictability of performance is very wise. So I want to thank you. We've had a good session on counting capital, and we did some good learning. And I look forward to having you back on one of our podcasts in the future to hear more about your success. So thank you very much.
thank you, Robert. It's a pleasure to be here.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.